It's easy to get fixated on our own daily routines, our own activities and responsibilities, our own families, friends, schools, workplaces, and communities. We all have to-do lists, and it's reasonable to get lost in the activities on that list, sometimes overwhelmed by the activities on that list. That hustle and bustle of daily life is one of the many reasons that we are often inattentive to the complex ways that our lives are connected to, affected by, and influence the lives of other people we don't know and may never meet. But that doesn't mean that such connections are not there, nor that they aren't profoundly influential to our lives. They're just not always easy to see, examine, or understand. Unless we see how social structures shape our lives with the use of a sociological imagination. The importance of a sociological imagination is put on full display when we examine the financial crisis that occurred in the fall of 2008, a crisis that set in motion the Great Recession that followed. From the outset, I must note that this video is a very concise assessment of the dynamics that led to the financial crisis in 2008. There are many factors at play here. If you are interested in taking a deeper dive into the intricacies of this historical event, especially the parts that played out on Wall Street, I highly recommend reading Michael Lewis's book, The Big Short. Yes, it was also made into a movie with Brad Pitt, Ryan Gosling, and a bunch of other people you'd recognize, but you should read the book instead, or at least read the book first. Nonetheless, here goes. In the early 2000s, we were attempting to come out of a fairly mild economic recession that preceded the 2008 financial crisis. To do that, the federal government, specifically the Federal Reserve, did essentially the only thing it can do to stimulate the economy if it is sputtering. It lowered the interest rate. Now let's talk about the Federal Reserve. Lots of attention to this right now in the news. The Federal Reserve sets what's called the federal funds rate. This most directly affects banks, but it influences much of the rest of the economy because it determines how expensive it is to borrow money. It sets the baseline for the interest rate on our loans and lines of credit of all kinds. Imagine a lake and a bunch of boats floating on the surface. When the water level of the lake goes up or down, what happens to the boats? They go up or down with it. Same with the Fed. When it raises or lowers the rate, the interest rates for all our loans and lines of credit go up or down with it. The way that lowering the interest rate helps stimulate the economy is that it makes it cheaper to borrow money. So, people borrow money. Because they have more incentive to borrow more money, it doesn't cost them as much when they pay it back. And everybody borrows money. People buying cars, people going to school, people buying clothes and phones and tablets on credit cards, businesses covering their costs and buying new inventory. Everybody can save a little expense if they borrow money when interest rates are lower. This is especially true for people buying a house. Enter mortgage lending as a key driver of the economic boom that followed in the 2000s. A mortgage is just a loan to buy a house. Why would mortgage lending be so important to the economy, you may ask? Think about a home for a minute and all the stuff that goes into a home. Building a home, moving into a home, furnishing a home, improving a home, just living in a home, etc., etc. In a word, everything. Everything goes into a home. When people move into a home, they hire realtors, they hire movers, they set up new accounts for electricity, cable, internet. They buy new furniture, make repairs, put in new flooring, remove old flooring, repaint parts of the house, buy new appliances, and so on. And when people build homes, they hire contractors who hire construction workers, plumbers, electricians, painters, roofers, and excavators. Suppliers of all kinds of materials and retailers of all kinds of products all get to do business when people are buying, selling, moving in, and moving out of homes. Businesses as diverse as Home Depot, Floor & Decor, as well as Pottery Barn, Hobby Lobby, and Target, as well as Comcast and AT&T and Google, are all loving life when the housing market is booming. And booming it was in the mid-2000s. Almost literally, everybody and their mother was buying a house. An important point here. What role did lower interest rates play in stimulating this housing bonanza? For the vast majority of people who own a home, their house is the most valuable and expensive thing they'll ever own. And if you're borrowing money to buy something that's worth 6 figures or more, any change in the interest rate is going to dramatically change how much money you pay back on the loan. An interest rate difference of less than 1% can mean a difference of thousands of dollars, maybe tens of thousands of dollars in what you pay back over the life of the loan. And no one knows exactly when the Fed may raise interest rates again. In many cases, the rate you get when you initiate a loan gets locked in for the life of the loan. So if you're going to take out a mortgage to buy a home, you do it now because you don't know when this deal is going away. So the urgency of the incentive can be very strong. Keep the sociological perspective in mind here. Interest rates are policies, structures that enable and constrain behavior, and in this case, low interest rates strongly enabled and incentivized people to buy a home. Behind all of this were other organizations making more money than anyone else from the housing boom. Banks. Mortgages are serviced by banks, and during this time, banks were cranking them out faster than you can say new homeowner. There are at least a few ways that banks profit from mortgages. Let's first talk about the value of a mortgage loan. It comes down to a very simple equation. The overall value of a mortgage is equal to the principal plus the interest. The principal refers to the amount of money which you actually paid for the house. The interest is the total interest that you will pay for the life of the loan divided by the number of months and years you spend paying off the loan. This is important and we'll return to it later. The value of a mortgage is equal to the principal plus the interest. Remember that. So banks approve mortgage loans and people buy houses. Part of the way banks make money, obviously, is through the interest they charge that people pay back each month on their mortgage payments. But that's not the only way banks make money from mortgages, and during this time in the mid-2000s, they got creative. One way they treat mortgages is to package them and take them together to create a bond or a security. Let me explain. Let's say you and 100 of your friends all become new homeowners. And let's say you all go to a bunch of different lenders to get approved for your mortgage. But let's say all of your respective banks and lending companies do something with your mortgage right after you complete the sale of your new home. They sell your mortgage to another bank. And let's say JP Morgan Chase buys your mortgage. This is just a common example. I'm neither endorsing nor criticizing Chase here. Chase buys all your mortgages, as a matter of fact, and then adds them all together, adds all of their estimated value together to create a bond called a mortgage-backed bond, also known as a mortgage-backed security. A bond is just a type of financial instrument that people can invest their money into. It is mortgage-backed because its value is based on the value of the mortgage loans that were packaged together to create it. Banks can then sell slices of these bonds to investors who buy into these bonds with the expectation that the bonds will retain and grow their value based on the estimation that people will make their mortgage payments. Why would people want to invest their money in other people's debt? That's what's happening here. A bunch of people's home loans, all bundled together, then sliced into pieces that people can buy. Why? Well, historically, prior to the financial crisis that's about to happen in this story, investing in mortgage-backed securities was actually considered a pretty safe place to invest your money. It rested on a pretty good assumption about human behavior. No matter what, people would pay their mortgage. The way mortgages retain value is by people making their mortgage payments every month. People are going to do that. Like we said, the most valuable thing most people will ever own is their home. In addition, it's literally the roof over their heads. Even if things get tight financially in the household, one of the adults loses their job, there's an expensive medical emergency, people may stop going on vacation, they may stop going out to eat, they may cut back on their Xfinity package, whatever, but they're going to make that mortgage payment. They're not going to risk losing their home. Come hell or high water, people will find a way to make that mortgage payment. As long as they do, mortgage-backed securities will be in good shape. It's a safe place to invest your money because it simply depends on people doing what they're supposed to, and it hurts them if they don't do it. That logic is perfectly reasonable, until something unusually disastrous alters this very predictable behavior, and it did. In the mid-2000s, after it was very clear that the economy had recovered from the previous recession and the economy was booming, the Federal Reserve could have done what it had always done in the past under such circumstances. It could have gradually raised interest rates to cool things off a bit. But for a variety of reasons we don't have time to go into here, the Fed didn't do that and kept interest rates low. That's one structural condition feeding this mortgage bonanza. The second one involves what's known as subprime mortgage lending and its role in the market for mortgage-backed bonds. What are subprime mortgages? To understand subprime lending, it's useful to first understand prime lending. Prime is a term in banking that refers to a borrower who checks out, who is good for the money. They have a job, they have a record of paying their bills on time, they don't borrow too much relative to their income, they don't max out their credit cards, etc. How do banks know this? They look at borrowers' credit history, and specifically their FICO score. Everyone has a credit history that credit agencies keep records of, and banks look at that when you apply for a loan of some kind. It's reasonable. They want to know if you're going to pay back the money you borrow on time. If someone with good credit is considered prime, then you can get a sense of what subprime likely means. It's someone with less than pristine credit. Maybe they've made some late payments in the past. Maybe they don't have much experience with credit. Maybe they even have a default on their record. Subprime lending is the practice of approving loans for people who don't fit in the prime lending category. Banks and mortgage lending companies approved a vast amount of subprime mortgages in the mid-2000s. There are a number of reasons for this, some good, some not good at all. It was a way for some people to benefit from the financial stability that home ownership can bring, a fresh start, so to speak. But it was motivated in no small part by intense demand from banks and investment groups for more and more mortgages so they could produce, buy, and sell mortgage-backed securities. By 2007, hundreds of billions of dollars were invested in mortgage-backed securities in some way, and they were chock full of subprime mortgages. Here's where the wheels start coming off the speeding locomotive that was our economy in the 2000s. Banks on Wall Street are heavily invested in financial securities that are backed by mortgages, and a great many of those mortgages are subprime. And gradually, people start to default on their mortgages. Many of these loans were excessively complicated with all kinds of risky terms and conditions, on top of the fact that they were made to people who had subprime credit histories. They would have introductory interest rates that would be set to go up after an initial period of time. They would have penalties and fees for late or missed payments. They sometimes wouldn't even require borrowers to demonstrate an income to get approved for the loan. For many people, these details were buried in the fine print of complex mortgage documents, and for a number of reasons, many people did not fully understand what they were getting into. So when people missed a payment or their teaser rate expired and new rates and or penalties kicked in, their monthly mortgage payment would spike dramatically, far more than what they paid per month when they first took out the loan. So that assumption we discussed earlier that no matter what, people will find a way to make their monthly mortgage payment, for many subprime borrowers, their payments shot up so much, so fast, that it simply wasn't financially possible for them to make that payment. The only option at that point is to default on the mortgage, and the bank takes ownership of the house, also known as a foreclosure. Now imagine thousands of foreclosures happening for the exact same reasons for many months, especially in parts of the country with lots of subprime mortgages. That's what began happening, slowly and quietly at first, and then with extraordinary volume. Now let's return to our little formula that determines the value of a mortgage. Principal plus future interest. What happens to that future interest when foreclosure happens? Poof! It literally disappears. It's gone, never to be recovered again. It only ever existed on paper in the first place. And then what happens to anyone who invested their money in a bond whose value was based in no small part on the value of the future interest on the mortgages backing the bond? Poof! Gone. Investors saw massive losses. Who was invested in mortgage-backed bonds? In a word, everyone. People's retirement accounts, people's college savings accounts, university endowments. People and organizations throughout the economy were exposed to these massive losses to varying degrees. And most of all, banks. By fall 2008, banks weren't just broke, their balance sheets were decimated. Banks took such massive losses, they had no money. In addition to the losses they took on the mortgage-backed bonds, they were also exposed to complex financial instruments known as credit default swaps that took their massive losses and magnified them many times over. If you're interested in more detail on those, read Lewis's The Big Short. For the most influential banks, it was mathematically impossible for them to pay their debts. They had no money, so there was no money to lend. Thus began a credit crisis. There was no credit available. Who needs credit? Everyone. No one, including businesses and organizations of all types and sizes, would be able to get credit which they depend upon to function. If there had not been a massive intervention, the fallout would have been nothing short of disastrous. Many aspects of daily life, including essential services, would most certainly have been disrupted and may have just stopped for an unknown amount of time with enormous amounts of harm done. So how did we stave off this calamity? The United States federal government issued an $800 billion bailout to the banks at the epicenter of this crisis so they could balance their books and get money flowing through the economy again. Make no mistake, if these banks had not received this infusion of cash, they would have failed. Chase, Citi, Bank of America, Wells Fargo, among others. Some did fail. Bear Stearns, Lehman Brothers, two investment banks that used to be pillars of Wall Street, gone. They did not survive. Moreover, the Great Recession ensued. Home values cratered. People lost their jobs. People took huge losses to their retirement savings. The pain was overwhelming and far-reaching. The damage was severe for many people, but without the $800 billion infusion into the banking system, by most accounts, every institution we rely on to survive would have just stopped working. The bailout was not without controversy, of course. The $800 billion came from taxpayers and went straight into banks. It didn't get houses back for anyone who lost their home. It did not get people rehired who had lost their jobs, and it did not restore the losses to people's retirement savings. It simply prevented a disastrous situation from becoming exponentially more disastrous. Afterwards, when the dust was settling, there was a lot of effort made to assign blame. The government, Wall Street, subprime borrowers. There's plenty of blame to go around. In fact, there is so much blame to go around that it requires us to see this disaster sociologically as a product of a socially structured environment that enabled a lot of risky behavior on the part of a lot of people that together led to disaster. Could the Fed have raised interest rates? Sure. But there's often a lot of pressure and assumptions driving efforts to keep rates low, even in good economic times. Could traders at Wall Street firms have behaved more responsibly? Absolutely. And again, you should really read The Big Short to get a sense of the spectacularly excessive risks that became routine practice. But when mind-boggling amounts of short-term profit are staring you right in the face, well, we know the motivating force material wealth can be for many people. Could mortgage lenders have been more discerning in who they approved for mortgage loans? Sure. But pressures to do your job meant approving as many mortgage loans as possible. Could subprime borrowers have not signed on to such outrageous loans? Sure. But the ability to put your family in a home you never dreamed possible is extremely tempting, especially when the people offering the loan are making it as easy as possible to get approved, and everybody you know seems to be buying a home. Notably, all of the behaviors I just described were not just perfectly legal, they were strongly incentivized by an array of social structures in the U.S. at this time. Low interest rates, subprime lending, risky but lucrative financial trading and investing practices, cultural norms of the American dream that emphasize home ownership, they were all at play here, influencing people from Wall Street to Main Street making everyday decisions. You don't get systemic economic disaster without widespread participation in the causes of that disaster. If we want to avoid future disasters, we must be attentive to the ways that our laws, policies, and norms enable and constrain behaviors that expose us to varying types and degrees of risk.